Wondering whether to invest all at once or spread it out over time? In this video, we break down dollar cost averaging versus lump sum investing. Which is better? You'll learn the pros and cons of each strategy, how market timing plays a role, and which approach fits different investment goals and risk levels. Today, we will talk about dollar cost averaging versus lump sum investing. Which is better? So before we get started, make sure to hit that like button, also subscribe to my channel. Imagine you have a large sum of money to invest. Maybe it's a bonus, an inheritance, or savings you've built over time. The big question is, do you invest it all at once, or do you spread it out over time? This debate between dollar cost averaging and lump sum investing is one of the most common and most important questions investors face. The answer is not as simple as you might think. Both strategies have clear advantages and risks. Which one fits you best depends on your goals, your risk tolerance, and your view of the market. 1. What is dollar cost averaging? Dollar cost averaging, or DCA, means investing a fixed amount of money at regular intervals, no matter what the market is doing. Instead of putting all your money into the market at once, you spread it out over weeks, months, or even years. This method can help reduce the risk of investing a large sum just before a market drop. When prices are high, your fixed investment buys fewer shares, and when prices are low, it buys more. Over time, this averages out your purchase price. Many people like dollar cost averaging because it brings a sense of control and discipline. It removes the pressure of trying to time the market perfectly, which even professionals struggle with. It's also a popular way for new investors to start investing slowly and build confidence as they go. 2. What is lump sum investing? Lump sum investing means putting all your money into the market at one time. Instead of waiting and spreading your investment, you commit your full capital up front. The idea behind this strategy is simple. Historically, markets tend to rise over time. So, the sooner your money is invested, the longer it can grow. Lump sum investing benefits from the power of compounding because your entire investment starts earning returns immediately. This method can result in higher long-term gains, especially in a rising market. However, it comes with the risk that you invest right before a market drop, which can be stressful and painful. 3. Historical performance comparison. Looking at historical data, lump sum investing has generally outperformed dollar cost averaging in the long run. On average, markets tend to go up more often than they go down. By investing all at once, you get more time in the market, which usually leads to better returns. Studies show that lump sum investing beats dollar cost averaging roughly 2/3 of the time. However, this advantage depends heavily on market conditions. In volatile or declining markets, dollar cost averaging can limit losses by buying at different price points. It's a trade-off between the risk of short-term losses and the potential for higher returns. 4. The emotional impact of both strategies. Investing isn't just about numbers, it's also about emotions. Many investors struggle with fear and anxiety, especially when the market drops sharply after investing. Lump sum investing can cause panic if the market falls immediately after your big investment. Seeing your portfolio value drop significantly can lead to poor decisions, like selling at the worst time. Dollar cost averaging helps reduce this emotional stress. Because your money is invested gradually, you avoid the shock of a big loss all at once. This smoother ride can help investors stay committed to their plan and avoid emotional mistakes. For many, the peace of mind from spreading investments outweighs the slight potential for lower returns. 5. The role of market timing. Market timing is the attempt to predict when prices will go up or down and invest accordingly. Neither dollar cost averaging nor lump sum investing guarantees perfect timing, but they handle it differently. Lump sum investing essentially bets on the market going up over time. It ignores timing and focuses on being fully invested as soon as possible. Dollar cost averaging, on the other hand, breaks up the timing risk by investing periodically regardless of market conditions. 6. Impact of volatility on your investment. Market volatility, or how much prices go up and down, plays a big role in choosing between these strategies. When markets swing wildly, lump sum investing can lead to big gains or big losses very quickly. If you invest a lump sum just before a crash, you could see your investment drop significantly. Dollar cost averaging shines in volatile markets because it buys shares at different prices over time. This reduces the chance of investing a lot at the peak and cushions the impact of downturns. For investors worried about uncertainty or sudden market shocks, dollar cost averaging offers a smoother way to enter the market. 7. The cost of waiting to invest. One hidden cost of dollar cost averaging is the money sitting on the sidelines. When you spread your investments out, some of your cash is not working for you. If the market is rising steadily, this delay means you miss out on gains you could have earned. In contrast, lump sum investing puts all your money to work immediately. The opportunity cost of waiting can be significant over many years. The longer you wait, the less time your money has to compound and grow. 8. How your personal risk tolerance affects the choice. Risk tolerance is your ability to handle the ups and downs of investing without panic. If you get stressed when your portfolio drops, dollar cost averaging can help by spreading out your investments and reducing the chance of big losses all at once. If you are comfortable with risk and can keep calm even when markets fall sharply, lump sum investing can maximize your returns by getting your money invested as soon as possible. Knowing your own emotional response to market swings is key. 9. Tax considerations. Taxes can also influence your choice. Lump sum investing means you might trigger capital gains taxes sooner if you sell parts of your investment after a short time. Dollar cost averaging spreads your investments and can spread potential capital gains over time, potentially offering some tax flexibility. In some cases, dollar cost averaging can help manage your taxable income by controlling the timing and amount of gains realized. However, the tax differences between the two strategies often depend on your country's tax laws and your individual situation. 10. How to choose the right strategy for you. There's no one-size-fits-all answer to whether dollar cost averaging or lump sum investing is better. The best choice depends on your financial situation, goals, risk tolerance, and mindset. If you have a large amount of money and want to maximize growth with a higher tolerance for risk, lump sum investing generally offers better returns over time. But be prepared for short-term market drops and emotional ups and downs. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.